Hello everyone and welcome to TTT Markets. I am Fotis and today we are going to discuss why markets move on expectations, not the news. One of the biggest misconceptions in trading is this: a good piece of news should make the market go up. A bad piece of news should make the market go down. It sounds logical, doesn't it? But if you have traded long enough, you have probably seen something strange. A strong economic report comes out and the currency falls. A weak report comes out and the currency rallies. So what's happening? The answer is simple. Markets don't move on the news itself. They move on expectations. And once you understand this, you will stop being surprised by many market reactions. Let's look at some charts. Well, but before we go to the chart, let's simplify this. So imagine the market expects strong US inflation, strong US employment, or strong US growth. And those expectations become embedded in price. So when the data arrives, the market isn't asking, is this good? The market is asking, is this better or worse than expected? So this is a completely different question. So let me show you on a chart. This is EURUSD. Let me switch briefly to dollar yen. As I said, let's say we expect strong US inflation, strong US employment, strong US growth. All these expectations are embedded in price. The price already contains the information about the currencies. All the informations are there, they are reflected in price, and it is happening in milliseconds. It is happening very fast. So what changes? The reason that you see all these bigger moves is because of changes in expectations. They anticipate something different is going to happen. Let's take a look at EURUSD as well. And let's take a look at a historical example. You don't even need the exact news release. The chart itself tells the story. Notice this move lower in EURUSD before the data release this week. So we have a move lower. Why did this happen? This happened purely on expectations that have to do with the US-Iran war. We had expectations that there is not going to be a peace agreement. So, because of that, there are expectations about the future. This is why the euro dropped. However, in the meantime, we had different piece of news. There is an agreement, no, there is not an agreement. Bad CPI news regarding United States, euro goes up. Then again, news about the war. It comes down and it doesn't break higher. So can you see what the market is doing over here? The market is positioning. It is already anticipating what is going to happen next. So let's look at what happens when we have the release. The market has already reacted. So when we have the actual news, nothing much happens. In fact, in some cases, it will go the opposite way. Why? Because the good news was already expected. So for example, here, we had poor US CPI, we had expectations about an agreement in the US-Iran war, so the euro moved up. We had the actual release and it didn't go higher. Why? Because this was already anticipated in the price. So you go to the calendar, this is another thing you need to watch. You go to the calendar, this is from Forex Factory, and you see here we have the actual release, and here we have the forecasted and the previous. What is important is not in absolute terms, if this was better or if it was worse or what kind of number did we get. What is important is this a big miss as compared to the forecast? Do we have a big change compared to the expectation? This is the important thing, nothing else. So this is extremely important to understand. What matters is not this number on its own. What matters is the difference against the expectations. Is it a big miss or a smaller miss within the range? So let me now go back to the chart. So the important chart lesson here is this. Before the news, price often tells you what the expectations are. For example, you see here we have support. The price stops dropping. Why? Because of expectations. So pay attention to the trend direction, the positioning, the momentum, the market sentiment. The move before the event can be more important than the event itself. Remember, buy the rumor, sell the fact. Let's go to dollar yen. Look at this move. This happened on expectations about fiscal policy in Japan. And not only that, of course, we had worries about the US-Iran war, and we had safe haven run in favor of the US dollar. But then it stops. Why does it stop? And it starts moving in a range-bound way. Why? Expectations. What kind of expectations? Well, at 160, Japan will intervene to support its currency. The Ministry of Finance will intervene to support the currency. And it did. Before it did, we had a breakout, but then it moves quickly back into range and we had the intervention. But can you see how the structure changes? And from a strong trend to the upside, suddenly it changes and moves sideways. Why? Because of anticipation of what is going to happen next. And it does move lower and then it stops. They spent $70 billion to push the price lower. And it goes almost where it was before. Why? US-Iran war, expectations of what is going to happen next, expectations about the price of oil and what it is going to do to inflation. And again, it moves up to what levels? To the level it was before, and the price stops. Why does it stop? Again, anticipation that this is the level that we might get another intervention, so be careful. So do you see that the reaction after the event, it could be more smaller than expected, because already the anticipation is triggering the moves. So the market is already moving. Why retail traders get trapped? Here's the mistake. The traders, they wait for the headline. And this is happening because they are looking for a guaranteed outcome. They do not expect what is going to happen. They are looking for a guaranteed outcome. And they wish to react afterwards. But it is already too late. Professional money are often positioned days or weeks earlier. By the time retail traders see the news, the market may already be looking ahead to the next expectation. Buy the rumor, sell the fact. So again, let's take a look at this. Optimism, we have optimism in favor of the USD. It goes up, positioning increases, the news are good. We have stronger inflation in the US. The US economy is resilient, it is doing well. So does the US stock market. As I said, good news, everything looks positive, and it stops. It doesn't do anything. We have some fake breakouts and doesn't move higher. Why? Weeks before this event, we had expectations that 160 is the level. So the traders are taking profits, they are closing positions, and the buyers are not so aggressive to push higher. Again, buy the rumor, sell the fact. This is difficult to understand for newer traders because they naturally focus on facts, but the market focuses on differences. Specifically, as I said, looking at the calendar right here, expected outcome versus actual outcome. This is what creates the movement. Let's take a look at EURUSD now. Let's take a look at this event over here. We had strong trend, strong positioning, extended moves, one-sided sentiment, and then it stops. Why? What do the news say? Consider why did we change here and why did we have again this consolidation and then it changed direction. Why? Again, expectations, news. It's news hitting the markets. So the market is positioned one way and then suddenly the actual result, the actual expectation is different. So this is when you get explosive moves, strong momentum moves. Not because the news is important, it's because the expectations were wrong. So people need to get out and move to the opposite side. So that's the key, that the markets move most aggressively when expectations must be adjusted. We have big headlines sometimes and almost no movement. Why? Because the expectation is already matched. So you must look when you are reading the chart, you must pay attention to the trend persistence, the momentum, the positioning behavior, the market reaction, but you should also understand the narrative. What is the expectation? What is the theme? This is what the professional traders will think differently. What will the news be? What is already priced in? What is the theme we are trading? Because trading is about surprises, not information everyone already knows. So what is the conclusion here? That the news itself is only part of the story. What matters is what the market expected before the news arrived, and then what are the actual news. This is why good news can produce selling and bad news can produce buying. Major events can create no movement at all because markets don't react to information in isolation. They react to whether that information changes expectations. In trading, the question isn't whether the news is good or bad. The question, and remember this, is whether the news is different from what the market was already expecting. Thank you for watching. See you in the next video.